In this video, we'll be covering time-based liquidity. Every time you trade, you're making the wrong decision, even when you're right. What does this mean? When price takes out an old high, how do you know that that buy side liquidity is going to cause a reversal, or if it's just going to cause a retracement and then keep going higher? How do you know if you're trading at the right time? If you don't have your actions predetermined before entering the market, you're using a reactive approach, which is highly subjective because you're reacting off of the price feed that's being offered to you. Just like in blackjack, the dealer has to hit until they reach 17. Once they hit 17, they stand. It's a mechanical system, and they're working off a rigged shoe that's in the house's favor. But the player, they don't have a mechanical system. They're reacting to the new cards that they're dealt, and they're making on-the-spot decisions based on how they feel. Based on the cards that they're dealt, do they feel like this is a good chance? Basic strategy says this, but they're reacting to it, right? They don't have a predetermined system of, okay, if this happens, then I'm going to do that. Versus the dealer, they have to do this until it reaches 17. Once it reaches 17, they have to stand. So your trading should be, okay, at this specific time, I'm looking for this in price. If it doesn't present itself, I can't trade. If it's not this time, I can't trade. If you're reacting to price going above an old high and saying, I feel like it should reverse here, you're making an on-the-spot decision reacting to price. It's highly subjective, and you have no statistical edge doing that. There's no data that proves, based on how you feel when price trades above this buy-side liquidity pool, that is going to be profitable over time, that you're going to have some type of edge. You're going to beat the market doing that. You're not. So the point of this video is to have a structured approach to, okay, before I trade on Wednesday tomorrow, which levels am I looking to sponsor moves? And what historical data proves that that level is likely to do this? So we're going into the market already knowing what we're doing versus what is retail doing? They're going into the market reacting off of certain highs and lows, saying, okay, 2022 model formed here, silver bullet formed here, but how do you know if it's just going to cause a reversal off of that old high, or it's going to trade back into it like a breaker or a mitigation block, then expand? So using these time-based liquidity pools, it gives a structure so at least you're not reacting to price. Then you can frame what times you want to trade as well. So a good start to this is to stop using the wrong price levels. Do not use very minute liquidity pools because, first of all, there's no liquidity. If price forms a low on the 1 minute chart at 1237 and pulls off of it for 15 minutes and then takes it out, yeah, there's a little bit of liquidity beneath that low, but it's not going to sponsor a lot of movement. So the benefit to using these time-based liquidity pools is that you're likely to get some movement off of it, at least, whether it be retracement or a reversal. You could still frame a trade off of that level. So the first step is to stop using insignificant levels that won't sponsor much movement. And how do you not do that? Well, the reason a lot of us do it is because we're impulsive, right? We see price above an old high, and we're like, oh, it hasn't traded above an old high in 30 minutes. I better take this. But if we already know the price levels that we want to trade at, if I know I want to trade at this time-based high, and I already know the window that I want to trade in, it's a rule-based approach that cancels out the possibility for impulsiveness because we're saying we can only do this if it's at this price level. So we're not reacting to price being above old highs. We're not fearful. We're using specific price levels. The benefit to using time-based liquidity, like I said, even if price doesn't cause a reversal, if you're using these higher time frame big levels, you're likely to still get some movement. And I'm going to show you guys a chart example of what this looks like. It's more forgiving. If price takes out that 1237 1 minute old low and it only was above it for a little bit, there's not much liquidity. So yeah, it might take out that low. It might wick it on the 1 minute chart, but then it just cuts right through it. Sometimes that 1237 1 minute low will cause a spike back up. But here's the bad part. If you're right about it that one time, you're getting rewarded. So even if you're right, it's setting you up to be wrong. So that's kind of the roller coaster that the market maker takes you on. It'll work sometimes. You'll gain confidence in it just to gain enough confidence for you to press the button, and then that same idea is used against you at a later time. So having a mechanical approach to knowing what we're going to do cancels out the possibility of reacting to price. We do not want to be reacting to price. So we talked about there's more liquidity beneath these higher time frame key time-based liquidity pools. I'm going to dive into what these time-based liquidity pools are next. Also, just look back test it. These historical time-based liquidity pools that I'm going to cover in a second, you're likely to see some type of reaction over them. Obviously, there are going to be times where it just expands through it, and that's likely because you're offside with the higher time frame move. But there's just so many benefits to already having a predetermined level to trade off of. So what are those time-based liquidity pools? We want to use monthly highs and lows, weekly highs and lows, daily highs and lows, and session highs and lows. And if you guys want to know more about the look back period for these highs and lows and a more structured approach to finding the draw on liquidity, I cover all that in my Discord. But these are the liquidity pools that you want to be focusing on. They're likely to sponsor larger moves and they're more forgiving. We're going to dive into some examples where you're going to see price was not even going down. Like it takes out a monthly high and the draw on liquidity was still higher. But because it's such a higher time frame level, one singular daily candle can go up to a monthly high. It can cause a wick reaction. So price can open up. It could trade up to that monthly high and then slightly close lower than the open. But because that wick is several hundred handles, it can offer a counter trend trade. So if you just kind of narrow your focus into using these key levels to frame trades off of, even if you're not picking the exact reversal points, you're likely to get some type of movement off of it. So what does this look like on a real chart? We could either target these time-based liquidity pools or we could frame trades off of them. If price is close to them, these are strong magnets because there's a lot of liquidity. And at the end of the day, the market is seeking to absorb liquidity. If you look at the most recent video on my channel, we talked about this last up close candle, and we were anticipating price to expand right off of that level into these two specific highs. Specifically because this is the high of the month of April. So this is a previous month high. So we're targeting that. And above that, this was a weekly high. So these were both objectives. You can see price gapped up and reached it there. But trades can be taken to these time-based liquidity pools or off of these time-based liquidity pools. This is what I mean by these levels are very forgiving. Historically, if you go back and you look at those time-based liquidity pools, the monthly highs and lows, weekly, daily, and session highs and lows. For the session highs and lows, I'm talking about New York session, Asia session, and London session, looking for trades off of them or to them, because the market tends to gravitate because they are massive liquidity pools, and the higher up you go, the more liquidity that's resting beyond them. So what do I mean by these time-based liquidity pools are very forgiving? Well, if this is a 1 minute chart, you're not going to take a short off of this because this doesn't offer large enough of a range. But for the daily candle, I mean, from this high back down to this open, that's several hundred points. So even though the draw on liquidity is way up here, right, it's targeting this high and this high, which is what we talked about in the previous video. And also you have this previous high up here. This is at around 21,350. It didn't reach it yet, but that's the overall draw on liquidity in my opinion, which is still a little bit higher than where it's at right now. This is the previous month's high. So this is March monthly high, which is why I think it's going to gravitate towards there. But even though price is going to go up to there, right, this is the monthly high of April. And look at that reaction off of it. So even though it cuts right through it, if we drop down to a 15-minute time frame and we go back, see how using this time-based liquidity pool still offered a retracement back to the downside, versus if this was a 1 minute chart, you're not going to trade this 5-second drop back to the downside. But since it's a daily candle and these candles take much longer to print intraday inside of that daily candle, this move down can be several hours. So it can offer a price run that's likely to last longer and it's likely to be larger in magnitude. Using these higher time frame levels offers larger magnitude price runs. And like I said in the Discord, we do talk about using these levels for manipulation and for offset and kind of structured plans. So predefined actions in predefined market conditions. So when the daily bias is bullish, how we want to approach using these. When there's no daily bias and we're relying on a 1 hour or 4 hour chart, right? What are we looking for in price using these levels? What are we targeting? So all of that I cover in the Discord. So the point I'm trying to make is that we want to take trades to these levels or from these levels. When it's close to it, we want to take trades to it. And if price takes it out, we can take trades away from it. We could also use filters like if the higher time frame bias is higher, maybe we won't take a trade off of that level because we think price is going to cut through it. But this at least gives some type of constant variable where you're constantly looking for these specific price levels and these price levels only. And you can refine that more by only trading within specific time windows, such as the AM session 8:30 to 11 a.m. or the PM session 1:30 to 4 p.m. If you combine the time with predetermined price levels and then looking for price to trade to them if it's close to it, because again, it's going to be a magnet. These are highly liquid levels. There's a lot of money above old highs and below old lows, these specific ones. So you have a much better chance at framing high probability setups off of these levels because there's more liquidity and they're higher time frame levels. And also you can track them. So you can collect data on specific levels, and over time, you can kind of get a feel for, okay, I'm using a fixed level, right? But at this time, it doesn't really work that well. Or on this day, it doesn't really work that well. Or if the higher time frame bias is even higher, it might expand beyond that session high and go to that monthly high. So things like that you could use as filters, and you can collect data, and you're constantly getting feedback on the same levels all the time. Versus what is retail doing? Price goes above an old high. It hasn't gone above that old high all morning, so they feel like they got to chase it at that price, right? They're constantly making decisions off of what price is feeding them versus what I'm teaching you to do here, which is you already know what you're going to do at a specific price level and you know the time you're going to be trading it. We're not reacting, we're anticipating.